Welcome, ladies and gentlemen, Glencore Resource Investment Conference, Commodity TV for you. Now we are at the booth of First Cobalt, and Trent Mell, the CEO, wants to give us an update. Trent, welcome.
Thank you, Jochen. Good to see you again.
Hey, good seeing you, and thanks for taking the time. It's been a while. We were talking, I think, PDAC last year, but a lot of good things happened. So I think we should do a little bit like an update. And first of all, congratulations to your deal with Glencore, because that's outstanding.
Yeah, we're excited. So I've kept a low profile. One of my investors said, Trent, you've gone from running a company to running a business. We've got the refinery, we've got Glencore, we're doing 2 feasibility studies. And so, other than this show, this resource show that I'm at here with you today, we've been very busy just doing our studies. And in short, like since we last met, we did some tests on hydroxide, cobalt hydroxide. Right now, 70% of cobalt mine feed is coming out of the DRC. Most of that's in the form of a semi-processed material called hydroxide that goes to China. And as a result, they dominate 80% of the battery form of cobalt sulfate. And so the deal with Glencore is, let's divert some of that away from China and bring it right to North America. We've got the only facility on the continent that's built and permitted and can make battery-grade material. And they put money in the company. They sponsored us to do our feasibility studies, and we're about 80 days or so, end of March, we'll have our feasibility studies done. And if things go according to plan, if we're able to replicate what we did on a scoping study level, then you're going to see us move into developer status.
Fantastic. And so how much money do you approximately need to really go into this production scenario, which is then like, I think, over 5,000 tons of cobalt will be produced out of them annually, right?
That's correct. So our goal is to 55 tons per day, which then makes us about 7-8% of the cobalt sulfate market worldwide. So we would immediately become a significant player and the only player on the continent in the battery space. So with this EV revolution, anybody looking to set up a battery supply chain here on the continent would necessarily have to take us into account.
Of course, there's a lot of battery factories already there and being built, right?
And coming,
and they need your feet.
Yes, last year was really, I'll come back to Capex, but last year was about Europe, right? We had a lot of announcements, Northvolt and others building plants on the continent. North America's playing catch up in December. LG Chem and GM announced a $2.3 billion plant. I guarantee you there's more coming in the next 12 or 18 months. And so we're a little bit ahead of that, which is fine. In terms of the Capex, Glencore invested $5 million US dollars in the form of a loan. So I'm trying to control the dilution because our business plan shows some pretty good margins. If all goes, if we're able to replicate what we did at the scoping study level, the total Capex for the initial recommissioning at 12 tons per day, which I hope to achieve in November of this year, is, and plus the 55 ton a day expansion 1 year later, is about 40 million USD in addition to that.
Those together.
Yeah, 40 plus 5, so call it 45 million.
Not a real amount of money. I mean, it's amazing.
No, and so I came out of, as you know, I come out of Barrick Gold and Sherritt and North American Palladium, so I'm used to bigger numbers, right? We're talking in the hundreds of millions, billions. This is a small amount of money, right? $45 million in your cash flow, and this is a facility, as you know, it's built and it's permitted, and all the work we're doing is inside the building. So we're not worried about a mine plan, because the feed is coming to us, 30% cobalt grade. We're not worried about infrastructure, it's all there, roads, power, tails, building, and the feed is right there, the permits are in place. And so execution risk, let's look at our Met results, they're coming. Look at the Met results, get comfortable with that. Look at the commercial contract that we have with Glencore, look at what our share of the margin is going to be, and if those 2 boxes get checked, the execution risk is quite modest for our industry.
And the good thing is you must not look for a market because the demand is so high and it's in front of your door. And that's what I like. It's North America, of course. Super. Also, congratulations on the resource you again brought out for Iron Creek. I mean, can you comment a bit on that? That was great.
Yeah, so I like to say that when I look at 2020, First Cobalt, we're not a mining company, we're a chemicals company. We've moved further downstream. But the upstream is still there, right? We still got the Cobalt Camp. We've got 50 past producing mines, high grade, no resource yet, but we've been focused on Iron Creek. So Iron Creek, Idaho, one of only 2 places on the planet where you have true cobalt deposits, not byproducts, low grade nickel low grade cobalt in a nickel. This is primary cobalt with copper. And so that resource, almost every drill hole we put into it is hitting mineralization. Noranda, many years ago, did some work, so we've got our roadmap already laid out for us. And this resource was basically infill drilling. In a tough market, we didn't want to spend too much money stepping out, building new roads and drill pads, so we did all the infill. We converted half of that inferred resource into indicated. We added 10% more tons. On a contained basis, the cobalt content's up by 12%, and all of that, importantly, for people who understand resource investing, all of that without dropping the grade. our cobalt grade stayed consistent through that drilling, and that's important. That's very important. Significant. What tells you is there's a real deposit there. There's good continuity mineralization, beautiful underground deposit right here on the continent, right here in USA.
Yeah, exactly. So what would be next, or what would be like a natural vision for Iron Creek? I mean, you would bring that out in production, right?
Yeah, that would be the idea. I think we've got to do some work on metallurgy. We're confident about the expansion ability of this resource. I'd like to see it double to make it interesting. We've also got a bunch of satellite stuff. So our VP of Exploration, Frank Santaguida, has got his boots at his back door waiting for the thaw. We've got the Ruby deposit we talked about recently. We've got a couple of other plays. If you look at our neighbor to the north, now Jervois, and their Idaho Cobalt project, they've got a bunch of satellite deposits around their permanent asset. And I think we're starting to get the sense that we have that as well in Iron Creek. And so we got to get out there and identify, what's at Ruby and what's at these other two plays, and start to grow an even bigger story outside of Iron Creek.
Wow, fantastic, great. That sounds like a good game plan, I would call it. Given 2020 and your partner Glencore, of course, I mean, that's a natural fit. You have the refinery, Glencore has the metal, and how does it work like with ESG, for example? I mean, when Glencore has like cobalt from the Congo, for example, is that an issue for the refinery, or how does that work?
Yeah, that's a great question. And we saw BMW last year did a deal with Glencore for their Australian alloy product. And that's to me a fascinating transaction, because they were so focused on not doing a deal with the DRC that they're effectively paying a premium for cobalt outside of the DRC. And by that I mean, by buying this product in Australia, it's a metallic, so they now have to incur extra costs to put it into its chemical form before it goes in their battery. So what does it mean for us? Well, our product is in the DRC, and most auto companies that I talk to, battery companies that I talk to, we all recognize we're not getting away from the DRC. That's 70% plus of the market today. The question is, from an ESG perspective, is where is it coming from? Most of the production is ethically produced. There's a lot of artisanal production that's ethical as well. In this case, it's one of two big commercial operations. It's Mutanda and it's Katanga. And so I've told the auto companies that we're in discussions with for offtake, you're never going to be embarrassed. You're never going to have a red face. Why? Because the feed comes from the Congo, from a single big commercial operation, a company called Glencore, and all of it's coming to a single refinery, and you don't have this risk of us blending Glencore feed with artisanal feed with unknown feeds out of an LME warehouse. Single source, single product, so we'll be able to stamp that quite comfortably, and I think anybody buying it should be very comfortable with that.
So that means
outcome.
you easily can fulfill all the UN standards, ESG standards, all that stuff.
Yes, and Glencore has tracked they've got their own standard now that they're rolling out.
Super.
We're going to have to do our own diligence, but I think you'll see us fall in line with the same standard, so that it's an easy traceability exercise.
Super, perfect. I know it's maybe a little bit too early to talk about margins in the refinery, but can you give us maybe a bit of a sniff?
Sure.
Do we talk about, let's say, 20-30% margin? Is it even more? What do you think?
Yeah, so, and you're right, it's early, because initially we've got this backstop with Glencore prepared to provide all the capital. I'd like to bring our own sources of capital in, and this would all be in the form of prepayment off the offtake, or effectively debt, and so no equity dilution. So until we get that settled, the commercial contract will have some issues we're going to need to sort through over the next 120 days. But you can look to the current situation with the DRC, where you sell your hydroxide to China and you get a payability factor. So if you were to apply that math to our refinery, 11 million pounds or 5,000 tons of cobalt, at $20 cobalt, that's about $220 million of cobalt value. DRC miner on average might get 70% payability, $154 million. That leaves about $66 million of value captured by a refinery of the size of First Cobalt. Our estimated OPEX on that annually is $26 million. You're left with $40 million of EBITDA, call it, on the asset level. Now that's merely an illustration, but it gives you a roadmap for what a facility like this could do given their known OPEX, which incidentally I'm told is competitive with what we know about the Chinese operations. So this is not, even though we're outside of China, it's not a white elephant. It can compete on the global scale. And the feasibility study should flesh that out for us.
Fantastic. So that means to me that you almost earned your market cap per year then.
Yeah. In fact, if we were to capture all of that, in the first few years, Glencore will have their stake. But you know what? Look, it's a great way to get to cash flow. We can be cash flowing modestly to start, cash flowing within a year. We've got a great partner, as you say. We got the capital, we got the feed. They're going to help source the offtake for us. And so for us to step into an operating basis on an immediate timescale with a partner like that is a great exercise. And I'll add, on the operating side, we're working with Ausenco right now on the engineering study. We are likely to do an EPC contract. We're likely to engage a firm like that to help us run it for a year or two. Too many juniors, they want a home run right out of the gate. And my commitment to shareholders is we're going to minimize our dilution, and we're not going to, as we say, swing for the fences. We're going to take it one step at a time. We're going to walk before we run, and we're going to build a long-term sustainable business. You got it.
Super, perfect. Trent, thank you very much. All the best for that. And I presume you have heavy workflow this year, but it looks like finally a big success.
Yes.
Because production should start.
Very, very excited for the year.
Super.
Yes, I got a great team too. Thank you.
Great, love it. Thank you, Trent. Yeah, ladies and gentlemen, it was Trent Mell, the CEO of First Cobalt, and you heard it. This year, this company will go in production with their refinery. They start small with 12 tons per day, ramp it up to 55 tons per day then in 2021. And so the company will generate cash flow. They have Glencore as a partner, and they have their clients just in front of their door. Because in the US, in Canada, you have the big battery metals companies who are producing for the Toyotas, the Teslas, the Mercedes of this world. And that's exactly what you want to have. And they can track ESG, they do the UN regulations, so everything is safe and clear. I suggest you check out the company. Thanks for watching us, and bye-bye from Vancouver.